Well, hello everybody. This is Paul Conrad, CPA from Richmond, Texas. Richmond is in the suburbs of Houston, I guess you'd say. Houston, Texas, where my home is. Been making a few videos about topics that are of importance to people who are in business for themselves. I'm a CPA and I prepare tax returns. Most of my clients, not all of them, but most of them are in business for themselves in some form or fashion. They own their own business. Maybe they own real estate. They can take a variety of ways that happens, but most of my clients are in business for themselves somehow. And usually somewhere along the way, the client says, teach me something about retirement plans. You know, we've put some strategies in place. Maybe we're a year or two down the road and they're starting to save some pretty good money. And they come back, you know, I see these clients every year, oh, maybe even a little more than that. And they come back and they say, what do I do with these savings? I don't really have a preference what kind of savings or what you do with the savings. I just want you to save it. I don't want you to consume it. That's not kind of the point. The point is to create some savings so that you can have more financial freedom later on. You'll have more resources at your disposal when you retire. And I love the client who we save them some money and they actually save the money. They just don't ratchet up their lifestyle. In any case, so clients will come back a couple of years later and go, what do I do with these savings? And I say, do you like real estate? Invest in real estate. Some people love real estate and they wouldn't touch this stock market with a 10-foot pole. I have other people who go, real estate's just not my bag. But I like the idea I can go online and I can buy and sell stocks and bonds and do whatever. I say if that's your bag, that's what you want to do. But I don't really have any preference what you do with your savings. I'm really just encouraging you to save that. Well, some people, they're not the real estate kind of people. They're more the stock and bond, Wall Street kind of people. And they hear and they see and they read in a magazine or something about being in business for yourself and opening up your own retirement plan, and that's a great option to do with your savings. For the most part, you can open up a retirement plan. You can take a deduction for it now, so it saves you some taxes. That money's going to be yours, but I use the phrase retirement jail. That money's in jail until you get to be the right age when you can pull it out. Now you can pull it out beforehand, but there's a penalty and a tax that goes along. So I kind of tell people, if you're going to use a retirement plan, it's not something you put the money in and get it right back out the next year or something. You're really pulling the rug out from underneath what the retirement plan is supposed to be doing for you. Kind of plan on, it's money I don't need and I'm going to put it in this retirement plan and it's going to grow tax deferred for you. Just kind of think hands off until I get to be at least 59 and a half, and you don't have to pull it out then. You can wait even longer, but there's a time frame you got to wait for this. Okay, let me draw a picture because you have to have a certain kind of income to be able to put money in a retirement plan in the first place. Let me draw a picture. So here you are, right here. And we're going to put a smile on your face because you've now met Paul Conrad and he's saving you some money on your tax return. The main form for a personal return is called the 1040. Hopefully you recognize that number. And we've set up some sort of a business. B-U-S-I-N-E-S-S. Now in the tax world, the trick is, how do I get the money from my profit of my business down here and pay as little taxes as I can along the way? That's the game, so to speak. And there's different ways to pay yourself, and they have different ramifications, particularly to this retirement plan topic that we have going here. I'm going to give myself a little bit more room to work with. In a prior video, I used the phrase the bad bucket 1 and the good bucket 2 to describe different kinds of income. Very briefly, the bad bucket 1 and it's not really bad, but I use that just for a description, is that when you pay yourself bad bucket one out of your own business, you're going to pay income tax on that, and you're going to pay Social Security tax on that. Two taxes on the one source of income. But the other option is what I call the good bucket two. So number two, or the good bucket, is income that when you pay yourself, you're going to still pay income tax on it, but you don't pay Social Security tax on this kind of income. So while this has two taxes attached to the one flow of income money to you, this one only has one tax attached to it. And we've talked about how as a business owner you can have a little or a lot of flexibility how much you put on each one of these arrows as you're paying yourself. You know, you're getting all the money here, but it's taxed differently as it gets to you, okay? It doesn't take long to figure out that when you have this flexibility, the less you pay yourself this way and the more you pay yourself this way, the less your tax bill ends up being. I mean, you know, that's fairly obvious with this. Hopefully it's obvious with this diagram for you. And I'll do this, and I'll show people how to do this split, and they go a year or two, and they are just as happy as clams. They just think this is the greatest thing. And then they come back. You know, I talk to my clients every year, sometimes more than once a year, a couple times a year. But somewhere along the line, it's usually about 2 years down the road, and they say, what about a retirement plan? My neighbor, I read a magazine, or saw it on TV, whatever, and it talked about retirement plans saving you money. Can I do a retirement plan in my situation? And I say you can, but there's some things you just got to know first. You just don't throw a retirement plan on there and it works. It doesn't in this kind. There's actually a variety of retirement plans, and some of them work better than others, actually. All retirement plans, though, however, require income on this arrow. This is bad bucket one. They all come, retirement plan contributions required that they are paid from this kind of income. You cannot use the good bucket two kind of income to pay to make a contribution into a retirement plan. As an example, I have clients where they've done a really good job saving throughout the course of their life, and their earnings is in the form of interest and dividends and capital gains, maybe rental properties, some things like that. Maybe they've invested in some other businesses and they get a form called a K1. Some of you know what that phrase is, what that kind of a form is. All those are this kind of income. And they say, can I put money in an IRA? And I go, you can't. And they look at me like, well, why not? And I say, because you have the wrong kind of income. You have to have at least a little bit of this to open the door to have that IRA or any of its several other number of kind of retirement plans. I just said IRA, but it's not the one I generally go with. Just an example. But you have to have some, and sometimes so they'll go, well, if all my income looks like this and I don't have any, okay, no retirement plan, and they go on with their life. Other people go, how can I get some of this? I go, well, you could go become a greeter at Walmart or something like that and get a W-2. The W-2 is the bad bucket one because you had income taxes and Social Security taxes withheld from the W-2. So W-2 it's an example of this bad kind of income in the sense that you pay two taxes, but it's also the kind of income you need for a retirement plan. So when you own your own business and you have flexibility between these, you're really trying to balance this sort of teeter-totter in a sense that you want to pay yourself and you want to minimize your Social Security, but at the same time, if you want a retirement plan to minimize income taxes, you may actually have to pay some Social Security to be able to get an income tax deduction for that retirement plan. And they kind of work against each other in a sense. And what I try to get clients to understand and accept is that you may have to pay more or a little more than what you had been and pay some Social Security and start to reduce how you pay yourself this way to open that door for that retirement plan deduction. Okay? Just remember this. All retirement plan contributions come from the bad bucket one, from income that you paid Social Security. Sometimes you'll hear it phrased, you have to have earned income to put money in a retirement plan. Well, this would be, I might use a different phrase, but that works for this. This is kind of the earned income in that comment. You have to have some of this earned income to get that retirement plan contribution and deduction for it, okay? So if you're doing this, just don't think I'm just going to layer this retirement plan on top of this whole thing and everything's great. No, you got to work this a little bit. You may have been minimizing this and maximizing this. Well, you may have to turn that over a little bit, and you may have to increase this and decrease this to get you that retirement plan contribution that you'd like to do. Okay, I hope that made sense for you. So thinking that you need some kind of this income, but maybe not a lot. Again, the goal is to pay yourself enough to get the retirement plan, but not so much that you overpay on that Social Security. You kind of want to find that sweet spot in between. With retirement plans, I think there's three things that you need to be aware of. And every retirement plan that I know of has different answers, different inputs regarding these three things. And you have to decide, we'll go through these three things, and then that helps you decide what kind of retirement plan is right for you. Fits your situation the best. The first thing you need to know is that every retirement plan has a limit on how much you can put in it. The smallest ones are the IRAs. That's $6,000. They're easy to set up. You put $6,000, kind of the end of the deal. The disadvantage of an IRA is you can only put $6,000. Well, maybe you save $20,000 and you want to put the whole $20,000 in a retirement plan. Well, an IRA won't get you there because the limit just doesn't get you there. If you're a little older, I think you can put an extra $1,000 in it or something, but for some people that's just not enough. So you have to be conscious of the limit. The second thing that you have to be careful of is the let's just call it the due date, or maybe we'll call it the contribution date. Contribution date. What that means is every retirement plan has a different time frame of when you can put the money in. And sometimes the door closes. You reach a date and the door closes for that year. Now, it's open for the next year, but it's closed for this year. Here would be an example. An IRA, you can put the money in the IRA during the year. You can put the money in the IRA up till April 15th the next year. So you got 3.5 more months to put the money into the plan. But let's say you put your return on extension. You just don't have your stuff ready. And you put it on extension. And now it's like May or June and it's time to do your tax return. And you say, I forgot to put my money in my IRA. Let me go do that right now. You can't. Because for IRAs, April 15th is the due date of the contribution date, the last day. So you can't put money in May in an IRA and take a deduction for it on the year before its tax return because the law just doesn't allow you to do that. Some retirement plans, you have to actually have the money in the plan the last day of the year. Some plans, you actually have to have the money in before the year even ends. Like the end of October, you got to have the money in for that year. We still got 2 months to go and you still got to have the money in. Really? Yeah, that's what the tax law says. Some plans allow you till April 15th. Some plans allow you even 6 months after that. So you got a long time frame of when you can put the money in. And depending what retirement plan you're thinking about, you kind of have to be aware of not only how much can I put in, but when do I have to put the money in? I've had people wait too long and they're a little bummed out. I say, you can do that plan, but you got to wait next year to do that, and your circumstances might change and you can't put as much money in and whatever. So just be aware you have dates that you have to be conscious of, okay? This one's fairly straightforward. Every retirement plan has an amount. Every retirement plan has a date. Now this one's a little bit harder. This third one is what I call the contribution rate. Now what that means is, and I've erased it, but imagine there was the box with the business, and you had this bad bucket one, the income that you paid both the income and the Social Security on. That's the arrow or the bucket that we're focusing on. And what contribution rate means is that how many dollars do you have to float down that arrow to get you a certain contribution, a certain amount of contribution that you can put in. Let me give you an example. Kind of remember this. We're going to talk more about this contribution rate, though. Limits, the dates, and the rates. And every retirement plan has different answers to these three questions that you have. Let's go back to here's our business. And here's your my boxes aren't such good boxes when I'm in a hurry. Am I on the? Yeah, I am. Okay. And we talked about this is the bad number 2. This is the good number 2. I said that wrong. Sorry about that. And here's the bad bucket 1. That's what happens when I do things out of order. Well, let's say that you want to put $6,000 in an IRA. Can you see that on my video? I think you can. So if you want to put $6,000 in an IRA, when you pay yourself, you have to essentially pay yourself $6,000 of this kind of earned income. You see that word a lot. So a $6,000 payment here will allow you to put that whole $6,000 into the IRA. So in that case, the IRA has I'm talking about these contribution rates now. The IRA has a 100% contribution rate. That means that for $1 of earned income, I can put $1 in the IRA. But you can only put $6,000 in. So we like the contribution rate of 100%, but we're limited by this fairly low limit on the IRA itself. So it has some good and some bad. You know, everything in life has an advantage or several advantages and one or more disadvantages, and you have to weigh the advantages and the disadvantages and figure out what's right for your situation. Sometimes we'll call this a 1-to-1 contribution rate. $1 of earned income you paid Social Security on, allows you to put $1 in the retirement plan. So $6,000 opens up the door to a $6,000 contribution into an IRA. Because the contribution rate for an IRA is 100%, or 1-to-1. Let's say, though, you go, Paul, I can do more than $6,000. I mean, I was thinking kind of, $10,000 or something like that. Well, there's another kind of retirement plan. By the way, that IRA, so the limit's $6,000. You have until April 15th of the next year to put it in. And you didn't incur a lot of Social Security tax. You only incurred Social Security tax on $6,000 to get a $6,000 income tax deduction. So those are the three things, and that's how they apply to an IRA. Some clients I have, they can do a little more. And so they do what's called a simple IRA, or sometimes we just call it a simple plan. Okay? The limit for a simple plan, all these retirement plans, they sort of edge up over time, and I have to go look up, well, what's the limit this year? But I'm thinking that a simple plan that it's about between $12,000 to $13,000. Okay, so it's more than the IRA. That's good. I can put about twice as much money into it. The date to put the money in the plan, it's at least by December 31st, if I remember correctly, and it might even be before that. So the advantage of a higher limit is a little bit offset by you don't have as long to put the money in the plan. I'm hoping I'm steering you right. Like I said, I got to go look these things up all the time myself. Some of my clients know these things better than I do because they have a particular plan and they know their plan. Sometimes better than I know all the plans, but you get the point. There's limits, there's dates. Well, on that simple, let's say it's $12,500 or so. So if you paid yourself $12,500 and you're going to pay income tax, or you pay it no matter how you paid it, but if you pay it this way, you're going to pay that extra Social Security tax. So if you're willing to pay Social Security tax on that $12,500, it opens the door for you to have a simple plan income tax deduction. Because a simple plan, it's still one of those 100% contribution rates. I think the contribution rate is really the most important factor of those three factors, or 1-to-1. So you only have to pay Social Security on $12,500 to open the door to get an income tax deduction of $12,500 because of this contribution rate right here. Makes sense. Oop. I erased my taxpayer. The one that I really like the most clients go, I get the theory behind this, Paul, but I was thinking more than 12,500 even. I got more than that. I got 20 grand or 30 grand or something like that. I go, that's awesome. Let's see what we can do with that. There's a retirement plan out there I call it the Solo 401k. It might be called the Uni 401k, the single 401k. There's a couple different kinds of things, kind of names for these things. But I call it the Solo 401k. Did you know that as a business owner, you can open up your own 401k? A lot of us have worked for other companies. We were employed. And one of the benefits was you could have money withheld from your paycheck and it goes in a 401k. I know you've all heard of 401k, but what you may not have realized is that you have every right as the business owner to open up a 401k just as much as British Petroleum or Exxon or Google or General Motors or whoever. You have a right to that kind of plan too. In fact, a 401k for a privately held business sometimes is a lot more flexible than the 401k for one of those big Fortune 500 kind of companies. The one I really like, this Solo 401k, it's only allowed where a spouse, the business owner or the business owner and the spouse can have it. Now you can have a 401k and have all your employees covered. You can do that. But there's a different kind of a 401k called this Solo 401k, and you can only have it in a husband and wife situation. If you're not married, you do it for yourself. If you're married, you can do it for yourself, but you can tag along your spouse. If you have another employee, you cannot do this Solo 401k. You got to do a regular 401k. That costs more money to set up. There's more regulations about it, stuff like that. You can do that. But if the simplicity of this Solo 401k appeals to you, just know you can't do it if you have another employee. So it works really good. If you're in business for yourself, you don't have another employee, and you're making enough money, more than what you need to live on, and you have this extra amount of money that you want to save. A lot of clients that I have are like that, and they do this Solo 401k. Here's how that one works. I'm going to erase part of this. We'll put Mr. and Mrs. back up here in a minute. But if you've ever had a 401k at a company, present tax law allows you to have $18,000 taken out of your check and put in this 401k. If you're 50 years or older, you can actually add an extra $6,000. And you can put, if you're 50 years or older, as much as $24,000 in a 401k at the big company. These same numbers apply to this solo 401k. So imagine you're a business owner and you've paid all your bills and yourself and everything, and you got 24 grand left over. What you could do is, let's put Mr. or Mrs. Taxpayer back up here. What you could do is this, using the flexibility between the good 2 bucket and the bad 1 bucket, you could pay yourself $24,000 here. I'm assuming you're 50 years old or older at this point. What's going to happen is you're going to pay income tax and Social Security tax on that 24 grand. There's no getting out of that. So you have to go, how much is my Social Security tax going to go up? Because I'm paying some money to myself this way, but how much income tax am I saving by doing that? And there's a formula to figure that out, actually. For a lot of people, this makes a lot of sense. Well, business operated by husband and wife and husband, neither one of them is covered by another plan anywhere else. And I have clients where they'll do this. They'll add the spouse, and both of them happen to be over 50 years old. So we can put 24 grand for each one of them into this solo 401k. That's $48,000. Now it means you're going to pay Social Security tax on $48,000, but you're going to get an income tax deduction for $48,000. Which one's better, the paying more Social Security and decreasing my income tax, or avoiding the Social Security altogether, but my income tax bill is going to be higher? So where's that sweet spot in the middle that makes sense for you? Okay, I'm going to show you how to calculate that. But I have a lot of clients where they make pretty good money, but they're not millionaires, nothing like that. You know, they're making a couple $100,000 or, you know, between 100 and 200, and they've arranged their life where they live on less than what they make, and they're going to save the money anyway. So the thought is, well, let's get an income tax deduction. Well, if we factor in the Social Security, a lot of times it makes sense. Sometimes it doesn't, actually. This works because I'm going to write crooked, 401ks still have that 100% contribution rate. So any plan that's 100% contribution rate, we like. Because we can minimize how we pay ourselves, but maximize the income tax deduction for that retirement plan. I would almost discount any plan that doesn't have a 100% or a 1-to-1 contribution rate. That's just how it works. Let's talk about the next one. This one comes up a lot. Let me give myself a little bit of working space here. The most common question I get when it comes to retirement plans are people who go, Paul, I've heard about a SEP, and I can put $53,000 into the plan. My investment advisor, you know, they manage my stocks and my investments, and they said, I need a SEP. Let's open a SEP. You can put the money in, you can invest it in any kind of stock or bond or mutual fund or whatever. Got a lot of flexibility for these Wall Street kind of investments, and you can put 53 grand in it, and I've seen it edge up from, you know, below 50 to mid 50, and it's going to go higher. It just is. They index these every year. And I go, I'm not a big fan of SEP plans. And I get this, well, why? Tell me why. My investment advisor thinks they're great. Tell me why you don't. And what I think the problem with a SEP is the contribution rate. See, the contribution rate on a SEP is not 100%, it's 25%. Let me give you an example. Let's say you have 50 grand, and you go, I'd like to put that into a SEP. Okay? So the limit for this example is, you know what? Let's change this a little bit just to make some math easier. Let's say it's 50 grand. Okay? You go, I'd like to put 50 grand in a SEP and get a tax deduction for it. And I go, we'd all love to get a $50,000 tax deduction for money we're going to get back. Okay? But a SEP, as I said a minute ago, its contribution rate is 25%, or what I would say is 4 to 1. Now, what does that mean? That means that to put $1 into a SEP, you have to pay Social Security tax on $4 of income. You need $4 of income for $1 into the plan, 4 to 1. That's where the ratio comes from, or 25%. Whatever you pay Social Security tax on, 25% of that amount you can put into a SEP. So how much, here's a math test for you. How much do you need to pay yourself in this bad bucket 1, that's incurring Social Security tax, to be able to put $50,000 into a SEP? Well, you could kind of reverse the formula a little bit, but basically you would have to pay yourself $200,000 of this bad bucket 1. You'd have to pay Social Security tax on $200,000 to give yourself a $50,000 income tax deduction for this retirement plan. It's not a very efficient way. We won't do the math right now, but I think you'll believe me and you'll trust me on this one, that the amount of extra Social Security tax that you paid on this kind of a number will be more than the income tax savings you'll get because of that deduction. A SEP actually increases your tax bill, your overall tax bill, when you factor in the income and the Social Security. So when that investment advisor, that asset manager said you need a SEP, all they're thinking about is income tax. Now, this is not a knock on the investment advisors of the world. That's just how they see the world. They don't see the world. They're assuming that your income you've already paid Social Security tax on, and that the door is wide open for you to put money in that SEP. That's generally what they're thinking. What they don't realize is that the CPAs come into the world and we say, we're going to arrange your life so that you're not already paying Social Security on all of your income. We've tried to manage this number down and manage, conversely, this number up so that your total tax bill, including your Social Security tax, goes down. So the CPAs, we kind of pull a rug out from underneath the investment advisors of the world. We don't mean to. We're not mean-spirited. That's just how it goes. And I'm telling you this more for just to give you enough knowledge to know that, you know, $1 spent on Social Security and $1 spent on income tax, it's still $1. You know what I mean? So for this reason right here, I'm just not a big fan of SEPs. I talk people out of SEPs all the time because your Social Security tax bill goes up more than your income tax bill will go down. And when I explain this, people go, no one's ever explained this to me before. Well, this is really how it works, okay? So I kind of pull the rug out from the SEP, and sometimes I default back to that 401k example. I go, are you married? Do you have other employees? Those are big factors. Do you have does your spouse, is she covered, he or she covered by a retirement plan at work? That can actually stop you from having your own 401k for that person. If you're not covered by a retirement plan, you can have one. If your spouse, or you or your spouse, are covered by another retirement plan somewhere else, a lot of times that closes the door for you to have this extra retirement plan. You can't have 2 IRAs and put $6,000 in each one, or 2 401ks and put $24,000 in each one. You can't do that. There's a limit per person, no matter how many plans. that you have. So I'll go back to the client and I'll say, and I usually I know this. Are you married? Do you have another plan? And if the answer is yes, I'm married, and no, I don't have another plan, well, how old are you? Well, I'll go in my tax software and see how old they are. And if they're under 50, I'll say you could put 18 grand in, and we could put in 18 grand for your spouse. This assumes you don't have another employee, and now you've sheltered 36 grand out of your tax return. You're going to incur more Social Security tax. That's just the way it is. But you may save even more income tax in that process, okay? Sometimes the client goes, and if they're over 50, the numbers ratchet up by another 6 grand, maybe for spouses, both of them, husband and wife. They may say, I have another employee. And I go, well, that undermines the solo 401k. Let's think a little bit harder about whether you just do a regular old 401k plan, or will something else meet your requirement. So we try to find something that gives them an income tax deduction, doesn't incur too much Social Security tax, but also fits their situation. You know, they have a spouse, other employees. How old are you? Is anyone covered by another plan? How much money do you have to work with? What time frame do we have to work with? Remember, there's due dates for these kinds of things. And so this conversation is best had in October, November, December, and you plan this out so that you get the right amount of money into the plan, into the right kind of plan by the right date. And I have clients where I'll have maybe a half an hour conversation, an hour. Sometimes we go years and we don't talk about this topic, but they get something in place and they just keep doing the same thing, and now they're happy as clams. They understand. I got the best deal I could with these two taxes that kind of work counterbalanced each other. Okay. This last kind of plan doesn't work for everybody. It doesn't work for most people, actually. But you know, back in the day, you worked for a big company and you got a pension plan. You know, and you didn't, however many number of years you worked there, that was how big your pension was, and it, you know, when you retired, the check just kind of showed up in the mail, kind of thing. I have clients that actually have that old-fashioned kind of a retirement plan, a pension plan. The technical name is called a defined benefit plan, retirement plan, defined benefit. Sometimes I just call it the old-fashioned pension plan. And very briefly, here's how this works. I have clients who go, I have $100,000 more than I need to live off of. What can I do? Can I get a tax deduction for $100,000? And sometimes the answer is yes. Maybe you have an employee, you have an assistant over here or something like that. So you're the big dog and you have this, maybe you have an employee, maybe you don't. But you can set up a different kind of this plan called, you know, an old-fashioned pension plan. And you can actually put 50,000, 100,000, 200,000. I have a client who puts $300,000 a year. Now he makes about 600,000, but he doesn't need the whole 600 to live on. He needs about 300, and he has an extra 300. And he puts 300,000 into this pension plan, and it's a deduction. Okay, now he may or he may not be incurring Social Security tax on that 300,000. Okay, what do you mean may or may not? A lot of these plans are set up that if you pay, as an example, if you pay Social Security tax for 3 years, so you're paying a lot of Social Security tax for 3 years. Okay, don't get me wrong. It's expensive the first 3 years. But once you get into the 4th year, there's this feature of these plans that says if you've paid Social Security tax for 3 years, you can continue to put money in the plan and you don't have to pay any Social Security at all starting in year 4. So I have clients where they kind of bit the bullet and they paid Social Security tax on a pretty big amount, and that's because they had a very long-range plan, they were confident that they were going to have this fairly significant amount of extra money year after year after year after year. So this might be a 10-year plan for you. But if you're willing to pay a fairly large amount of Social Security tax for 3 years, you could set this up where you could continue to put, say, $50,000, $100,000 to $300,000 into the plan, and you don't pay any Social Security tax in years 4 and 5 and 6 and 7 and 8 and however many long. So you sacrifice the first 3 years for all the years after that. This is a very long term. You have to put some money in the plan every year. There's actually a minimum. You can't skip a year. You actually got to put money in the plan. You lost your job, or you lost your consulting gig. Let's put it that way. Still got to put money in the plan. So there's a lot of restrictions to this, but if you can live with that, and the fact that you paid a lot of Social Security tax for 3 years, it could save you a whole lot of money in year 4, 5, 6, 7, 8, for 20 years after that. So very long-term strategy, but if you're confident in that you can live up to the strategy, this allows you to put a lot more money in a retirement plan than an IRA, a simple IRA, a 401k, a SEP, an ABC or an XYZ or whatever, okay? This doesn't fit very many clients of mine at all, but when it works great. There's a lot that goes into whether or not you even qualify for this plan. So I can't give you all those details. It's beyond the scope of this video. Okay, if you were in front of me, I'd say, what are the 3 variables? The limit, the due date to put the money in, and most importantly, the contribution rate. If someone suggests a plan to you, ask them, what's the contribution rate? They may look at you kind of funny. You may have to go home and look it up on the internet, but you got to be careful. What is this contribution rate? And you try to find something that fits all 3 of those that makes sense for you. My last comment about retirement plans is this. Maybe you don't even want a retirement plan. Well, why would you not want a retirement plan? You get a tax deduction for it, don't I? Yeah, you do. Remember I said that everything in life has an advantage and a disadvantage. Retirement plans are the same way. There's advantages to them and there's disadvantages to them. The advantage is you get a tax deduction right now. The disadvantage is you got to pay taxes on it later. And what you pay later may actually be more than the tax savings right now. Really. Sometimes that happens. So you have some dollars and you put it right into an investment. And let's say you bought Google. And you put $100,000 into Google because you knew it was going to go up. Your neighbor takes that $100,000 and they put it in let's say it's a 401k or an IRA or an ABC or an XYZ or something like that. And that plan buys Google. So you both own Google stock. You both put $100,000 in it. The difference is your neighbor got a tax deduction on $100,000 and you didn't. So it sounds like your neighbor's ahead of the game. Your neighbor's beating you at this moment. Okay? Well, the game's not over yet. This makes sense. So Google grows to $1 million. 1 million. So you both got $1 million. Wouldn't that be a nice problem to have? And you're retired, it's time to start taking that money out. Okay? When your neighbor takes this money out, he's going to pay what's called ordinary tax rates. You know, our tax system has a series of increasing brackets. There's a 10%, and at the moment, 10, 15, 25, 28, 33, 35, and almost 40, and there's actually some extra taxes that could make the 40 even more than 40, like 42 or so. But we call that the ordinary tax rates. And when your neighbor, he starts taking money out, he's going to pay tax at these ordinary rates. depending on what your neighbor's situation is, those ordinary rates may be pretty high. He may be paying 25% tax on that Google stock as he sells it and starts to put it in his own pocket and, takes vacations and makes his mortgage payment and gives it to kids or whatever he's going to do, he or she. In your case, you start to sell some of this Google stock. It's worth $1 million, and you sell it. You made some profit, and well, first of all, how much profit? How much income are we even talking about? I'm jumping around a little bit here, but your neighbor got a $100,000 deduction going in. That was awesome at that time. But when he takes out $1 million, he's going to pay tax on $1 million at ordinary tax rates. You, on the other hand, you were a little more forward thinking on this one, looked into the future, crystal ball. So you take this money out, and you're not going to pay tax on $1 million. You're going to pay tax on $900,000 because you didn't get a deduction for the $100,000 going in. So when the $100,000 comes back out, that's tax free to you right off the bat. So you're paying tax on the difference between what you put in and what you took out. That makes sense. But how much tax are you paying? Well, you are going to, you've held this for a long time, so you're going to use what's called long-term capital gains. Gains tax rate. What is that? For most people, that's 15%. Could go a little higher. There's actually instances where it could go lower than 15%. Here'll be an example. If you're married and your only income is selling this Google stock, so let's say you sell this $50,000 a year for 20 years of retirement or something like that, your tax rate on that will actually be 0. So you hear this 15% rate, but it's not always 15%. Most people go, well, it's 15, but it might be 20. This is current tax law. That's not really the full story. It's 15. If you have a lot of income, it could be 20, but if that capital gain is your only income, it might actually be 0. And I have clients where I do their tax return, and their main source of income or their only source of income is this long-term capital gain, and they're married, they make, and they structure selling the stock and putting the money in their own pocket. They structure it where they make about $50,000-$60,000 a year. That's their only income. They've paid off their mortgage. The kids are gone. They don't need as much money, maybe. 60, maybe as much as $70,000. And the long-term capital gain rate for a married couple with no other income is 0. How awesome is that? The point of this last couple minutes is that the advantage for this guy or girl is they got a tax deduction immediately. But they're going to have to pay some tax, and it could be at a fairly high rate at some point in the future. This person didn't get a tax deduction because they didn't put it in a retirement plan before they invested in Google. They just opened a broker's account and invested in Google. And when they sell, they're going to pay capital gains, long-term capital gains rate that could be anywhere from 0 to 20%. This one could be anywhere from 0 to 40%. It just kind of depends. So I know people who they have money and they choose to not put it in the retirement plan because they're thinking long term. What will my tax be when I retire? Now there's a lot of variables that go into that way past this video. But I have clients that maybe they have 50 grand and they'll put 25 in a retirement plan and they could put the whole 50, but they don't. They put 25 in a retirement plan and they get a deduction for it, so the tax bill goes down. But they take the other 25 and they go just open a broker's account and invest it. And they're giving themselves 2 pots of money. So when they retire, they can choose which pot to pull the money out of depending upon their circumstances for that year and what their tax bill's going to look like that year. Very forward thinking, but something to think about nonetheless. So retirement plans aren't always the best thing to do. Gosh, if we only had a crystal ball that worked 20 years in the future, you'd know exactly what to do. I'm kind of throwing this out to you. That's it on retirement plans, and I hope that this made sense to you. I hope you found this valuable, enjoyed it even a little bit. Again, my name's Paul Conrad. paulconradcpa.com in Richmond, Texas. And I hope you have a tax problem. Not really, but I hope that you have enough taxes that you got to be worrying about this kind of thing. This is a good problem to have, really. Look forward to look to see more videos in the future, and have a good day. We'll see you down the road.